2 US dollars stock vouchers with a total of 20 available. To put it simply, a stock voucher is a cash rebate that you can redeem when your stock order is executed. And we will be giving out these lucky draw prizes at the following times: 7:32 p.m., 7:40 p.m., 7:45 p.m., and 7:50 p.m. So for example, at 7:32 p.m., a pop-up message will appear on your Tiger app inviting you to participate. You can simply hit participate to enter the lucky draw. And 5 random winners will be selected. So the winners will be announced a few minutes later after the lucky draw is conducted. And if you have any questions at all regarding this lucky draw, simply ask in the chat room within the Tiger app. My colleagues will be happy to assist you. Okay, let me go through the disclaimer first. This presentation is provided to you for education and sharing purposes only. It does not constitute to any form of advice. Past performance is not indicative of future performance. So today I'll be providing an earnings preview of Nvidia and discuss what's next for Nvidia. Additionally, I will introduce you to some AI-related ETF, such as Aiq ETF, SMH ETF, Igpt ETF itself. Okay, let's talk about Nvidia first before I discuss about AI ETFs. So Nvidia is one of my favorite stocks among the Magnificent Seven. The company is expected to report its earnings on May 22nd after the market closes. So I reckon Nvidia has the potential to overtake Microsoft as the largest company by market cap in the world. And it is probably not that difficult to do so because Nvidia just needs to go up by another 36% from the current share price to become the largest company in the world. Nvidia is probably the most popular stock at the moment, given that it went up 246% last year with a year-to-date return of 91%. It's now trading at $946.3, which is about 0.39% below its all-time high. So the all-time high was $950. So every trader is eagerly awaiting to see if the earnings result on May 22nd can push Nvidia over $1,000. But there are a lot of non-believers as well. If you look at the short interest in Nvidia, the total short interest is worth $23 billion. Currently, the short positions are near a historical high. The all-time high is 26 billion. I think most of these short sellers are waiting for the earnings news itself. Some of them likely built their short positions when Nvidia share price dropped about 20% 1 month ago. Nvidia earnings are important. Generally, Nvidia earnings release will have the entire market on edge because it is always the last stock among the Magnificent Seven to announce earnings. And Nvidia earnings generally do not disappoint as they tend to exceed expectations. Typically, analysts will have high expectations for Nvidia going into the earnings release date. However, Nvidia has managed to beat earnings estimates for the last 5 quarters. For example, in the 4th quarter of 2024, revenue beat estimates by 7% and earnings per share beat estimates by 11%. Having said that, you probably should not bet against Nvidia's earnings, as the earnings result on May 22nd may trigger a short squeeze, causing short sellers to cover their short positions at a higher price. Nvidia is trading at $946 now. What might happen once Nvidia surpasses $1,000? I reckon two events are likely to happen. Firstly, a short squeeze. As you can see from the large short interest from the earlier slides, I think the cut loss level is around $1,000. $1,000 is also a psychological resistance level. So I guess many technical analysts will set their cut loss level around $1,000. Secondly, a share split. When Nvidia's stock goes above $1,000, it will become less affordable. So Nvidia may announce a short share split itself to bring down the share prices. The last share split Nvidia did was in 2021. After the announcement of a share split, the stock itself went up as much as 38% in 2 months' time, right before the share split at stake. So even though a share split itself does not affect a stock fundamentally, it would typically attract buying interest as investors believe that a lower share price makes the stock more affordable. So here are some of the earnings estimates for the first quarter by Bloomberg Consensus. Generally, the forecast for the end April quarter is quite good, with impressive year-on-year growth estimate. For example, the revenue is expected to grow by 242%, operating profit by 661%, and earnings per share by 547%. So it is pretty tough for Nvidia to still beat the street estimate. But again, I think Nvidia will surprise all of us on the upside. So let's take a closer look at the fundamental itself, which is the financial statements. Currently, analysts expect the year-on-year revenue growth to be 242% in the latest quarter, and year-on-year operating income growth is expected to be 661% itself. Normally, other than year-on-year growth, I will also look at quarter-on-quarter, Q-on-Q growth. I did not show you the Q-on-Q growth here, but you can basically see that both revenue and operating income are hitting new highs every quarter. So basically, I believe that Q-on-Q growth is important to analyze a growth stock, because a drop in quarter-on-quarter growth itself indicates that the earnings momentum is losing steam. Year-on-year growth does not provide you the full picture, because it only compares the quarterly growth this year versus 1 year ago. So luckily for Nvidia, both revenue and operating income are still expected to hit new highs in the latest quarter. So this is the main reason I think Nvidia's share price can still maintain at a high level. Okay, let me spend some time to explain to you why the share price can maintain at a high level as long as the earnings growth momentum itself remains solid. Many investors rely on the PE ratio, price to earnings ratio, to determine if a stock is overvalued or undervalued. For example, they might look at the PE ratio of Nvidia, which is currently trading at 78.46 times, and consider it expensive compared to Apple PE ratio of just 29 times. However, a high PE ratio can still increase further as long as the earnings outlook, the future earnings outlook remains promising and sustain the high share price. Or the PE ratio can decrease if the earnings continue to grow larger and sustain the high prices. So this is why Nvidia PE ratio was trading at 218 times 1 year ago and has drastically decreased to 78 times now. This occurs because the earnings were growing faster than the increase in the share price. All in all, during a bull market, investors do not care too much about high valuations as long as the earnings can keep up. Okay, let's look at the profit margin. The gross profit margin is expected to increase to 77% in the latest quarter, while the operating profit margin is expected to increase to 66%. Suffice to say that Nvidia has one of the largest profit margins among all the technology companies. In terms of revenue by end user, data center has been contributing more to the total revenue from 45% in first quarter 2023 to 83% in the fourth quarter 2024. Whereas the gaming segment has decreased from 43% to only 13% during the same period. Having said that, investors nowadays will just focus on data center revenue growth. It is expected that the revenue contribution from the data center will increase to 86% this year and 89% next year. The data center has been experiencing triple-digit growth, year-on-year growth, revenue growth itself for the past 3 quarters. As you can see over here, it is really impressive. And here are some of the downside catalysts. I will only go through some of them. Firstly, the gaming sector recovery will still take a while. Nvidia has a commanding 83% market share in the gaming chip market. Therefore, if the gaming recovery itself continues to be lackluster, it could pose downside risk to the analyst estimates. In addition, Nvidia's heavy concentration on data center GPU revenue means that if there is a sudden dip in the demand in this data center segment, other segments like PC gaming may not be sufficient to offset the lost revenue itself. Okay, secondly, big tech companies are making their own chips, their own AI chips. The question is why they want to design their own chips. I would say that the tailored custom-made chips itself should help them lower the cost, consume less energy, and are expected to perform better because they are the bespoke solutions to their computational needs. But in the near future, they have no choice but to keep buying from Nvidia first. Because if they don't, they risk lagging behind in terms of AI training because Nvidia still has the best AI chips for now. Okay, the biggest risk for Nvidia is likely associated with China. The US has imposed a ban on exporting certain Nvidia AI chips to China. In the past, roughly 20 to 25% of the company revenue has come from China. But in the latest quarter, we could see that China revenue contribution has dropped significantly to just 8.8%. And yet, you do not see a drop in the total revenue growth itself. So I guess Nvidia has been doing quite okay without China for now. And there are rumors that Nvidia has found a workaround to continue exporting to China. The company has introduced a cut down or dumbed down version of the products that comply with the American export policies. Okay, here are some of the upside catalysts. Again, I will not go through them one by one. Firstly, potential share split that I mentioned earlier. Secondly, Nvidia has massive free cash flow now that I think Nvidia could use it for share buybacks or the dividend payout itself. Thirdly, the total addressable market is huge. It's estimated that the total addressable market that Nvidia is in is worth $1 trillion. Okay. In terms of the AI training, the total addressable market is expected to grow at a CAGR of 31% from 2022 to 2032, while the inferencing total addressable market is expected to grow at a CAGR of 48% during the same period. Essentially, Nvidia should have a commanding market share in both training and inferencing markets. Okay, why do I say so? Why do I believe that Nvidia will maintain a large market share going forward? Because Nvidia has already established a strong ecosystem around the AI chip through the Nvidia Cuda software. So many companies are using Cuda software to construct the AI models, and it supports Nvidia GPUs exclusively. As a result, many developers are already using Nvidia Cuda software and Nvidia GPU hardware. And because of the strong ecosystem, Nvidia is able to raise prices on the GPU, while AMD is lowering prices on the GPU. And what I really like about Nvidia is even though they raise prices, they are still able to capture more market share. Okay, here I'd like to show you the yearly return, annualized return, and some of the risk metrics for Nvidia and other Magnificent 7 stocks, S&P 500 and Nasdaq 100. Let's look at the yearly return first. Nvidia is the best performing stock among Magnificent 7 this year with a year-to-date return of 91%. So Nvidia has consistently delivered many triple-digit returns in the past. For example, in 2020, Nvidia returned 122%, and the following year, it returned 125%. So perhaps Nvidia can achieve another triple-digit yearly return this year as well, after delivering an impressive 246% last year. Nvidia has the best long-term annualized return among all the stocks here. It has provided a 71.6% 10-year annualized return with a maximum drawdown of 66% and a standard deviation volatility of 46.7% over the past 10 years. So it's one of the riskiest stock here. This is why I don't think that Nvidia is suitable for conservative investor. The current Bloomberg analyst consensus 12-month target price for Nvidia is $1015, representing an upside potential of 7.3%. Currently, 61 analysts recommend buy, 7 recommend hold, 0 recommend sell. In conclusion, basically, I think the AI bull market has legs, and Nvidia is poised to benefit from the AI development. Okay, Nvidia has also consistently surprised all of us on the upside with the earnings results and forecasts. I think as long as Nvidia continues to provide earnings surprises, the share price can remain elevated along with the expensive valuation itself. Imagine you are a portfolio manager managing an aggressive portfolio and have not been investing in Nvidia this year. In such a case, your portfolio is likely lagging behind the benchmark or peer portfolios. Therefore, I believe many growth portfolio managers have no choice but to keep investing in Nvidia, especially the year to date has gone up by 91%. To put it simply, many growth portfolio managers struggle to find an alternative to Nvidia. So Nvidia is currently trading at $946. I know it looks quite scary at the moment, but please also bear in mind that it also has corrected roughly 20% 1 month ago. So maybe the 20% corrections 1 month ago was the maximum drawdown for the year. Okay, Fibonacci expansion suggests that the next immediate resistance is $1,005, followed by $1,141 and $1,293. I think if there is a short squeeze when the share price goes above $1,000, it may push the share price to probably 1141. You can also refer to the support levels here as some of the potential accumulation levels. Okay, next, let me introduce you to some AI ETF. Many AI-related companies have gone up a lot in prices. For example, Nvidia went up 246% last year, and the year-to-date return is 91%. Many investors likely agree with me that they need exposure to AI companies. However, due to high prices, they cannot persuade themselves to enter the market. Therefore, one of the better ways to still gain AI exposure is through the ETF, as ETF can help you gain some market return. So the first AI ETF I like to talk about is Aiq ETF, Global X AI and Technology ETF. So Aiq ETF is investing in companies that potentially stand to benefit from the further development and utilization of AI technology in their products and services, as well as in companies that provide hardware facilitating the use of AI for the analysis of big data. Okay, quite a mouthful. To put it simply, this ETF will invest in companies that will benefit from their AI products, services, and Aiq ETF will also invest in AI hardware companies. The top 10 holdings include some of the large cap companies like Nvidia, Tencent, Netflix, Meta, Amazon, Qualcomm. One reason I like about this ETF is that it is really diversified. It owns all of the Magnificent 7 stocks, and the top 10 holdings only accounts for 34.77% of the total portfolio, and the ETF has about 84 companies in total. The ETF is 69% invested in US companies, 9% in China, and 6% in South Korea. Its 9% allocation in China comprises Alibaba, Tencent, and Meituan. In terms of sector allocations, 62% belongs to IT, while communication accounts for 16% of the total portfolio weight. So here are some of the other important key takeaways. Firstly, the AUM size is about 1.7 billion. Typically, any thematic funds with an AUM size of more than $1 billion is considered good. So Aiq is quite popular because generally the AUM size for any thematic fund is about few hundred million. The fund house is Global X. Global X was founded quite long ago, founded in 2008, and is best known for its thematic ETFs. Basically, you can find a lot of thematic ETFs under Global X. The total expense ratio is a bit expensive at 0.68%. It is passively managed. One thing I like the most about this ETF is it has all the Magnificent Seven stocks, accounting for 22% of the portfolio weightage. Dividend yield is about 0.18%. So it's quite negligible itself. Liquidity is quite good. The bid ask spread is about 0.09%. 90 days average aggregate volume is about 673,000 shares. The year-to-date return is not bad at 10.5%. Since the inception, there was only 1 year, 2022, that ended negatively. The 5-year annualized return was quite decent at 16.51%. On the side note, there is another similar popular AI ETF issued by Global X as well, which is called BOTZ ETF, Global X Robotics and AI ETF. So if you are interested, you can search for it on our Tiger app. The main reason I did not introduce it today is because I reckon there are a lot of smaller companies that I'm not familiar with in this BOTZ ETF. So at the moment, I would prefer Aiq ETF to BOTZ ETF. But probably I will talk about BOTZ ETF on a later date. Now let's talk about Igpt ETF. The full name is Invesco AI and Next Gen Software ETF. So Igpt ETF invests in companies focuses on next gen software teams, including in the areas of AI and robotics, among others. So since the name of this ETF includes software, naturally, I expect the ETF will focus on software companies. But still, you will find some hardware or semiconductor companies in this ETF, namely Nvidia, Qualcomm, Micron, Intel. So this ETF is quite concentrated on the top 10 holdings. Top 10 holdings account for 60.83% of the total weightage. So it depends on how comfortable you are with the top 10 holdings. For example, Alphabet, Nvidia, Meta accounts for 26.84% of the total weightage, which is a good thing if you really like these three companies. But I have some doubts on the companies such as Adobe, Intel appearing in the top 10 holdings. But luckily, Adobe and Intel only accounts for 10% of the total weight. So it's relatively small. Again, Igpt heavily relies on a few companies like Alphabet, Nvidia, Meta, Adobe, AMD, and Qualcomm to be successful. In terms of the country allocation, it's quite concentrated in the US, accounting for 86% of the total portfolio weight. The sector allocation is quite similar to Aiq. The IT sector accounts for 64%. Communications accounts for 23%. When you look through the holdings of Aiq and Igpt, some of them are overlapping, or you can say that Aiq and Igpt ETFs will choose different competitors in the same field to be included inside the ETF. So here are some other important key takeaways. The inception date is 2005. making it one of the oldest software ETF. However, the AUM size is quite small at 298 million. In comparison, AIQ has 1.7 billion in AUM size. Total expense ratio is slightly cheaper at 0.61%. One thing I dislike about this ETF is that the liquidity is quite low, with a 90-day average aggregate volume at 62,000 shares. The ETF invests in 3 of the Magnificent 7 stocks, accounting for 27% of the total weight, namely Alphabet, Meta, and Nvidia. However, I like almost all of the stocks in the Magnificent 7 itself. So I think investors should probably include most of the Magnificent 7 stocks to gain a better overall AI coverage. The year-to-date return was not bad at 17%. In comparison, AIQ was just 10%. 10-year annualized return was also quite decent at 15.75%, but you could probably notice that the ETF suffered 2 consecutive yearly returns in 2021 and 2022. All in all, the past performance looks okay in long term. Okay, now let's talk about VanEck Semiconductor ETF. The ticker code is SMH. So SMH ETF is my favorite semiconductor ETF. Basically, it's investing in 25 largest and most liquid US exchange-listed companies in the semiconductor industry itself. So as long as the company, not necessarily a US company, is a semiconductor company listed on the US stock exchange, it stands a chance to be included in this ETF. Here is an overview of the ETF. The ETF was listed in 2011. It has 25 holdings. The total expense ratio is quite cheap at 0.35%. AUM is 18 billion. So typically, ETF with larger AUM enjoys better liquidity. So the AUM size itself is the largest among all the ETFs I introduced today, and it has the best liquidity. The PE ratio is relatively expensive at 45 times. Price to book ratio is 7.8 times, making the valuations the most expensive among all the ETFs introduced today. On a side note, if you have been investing in semiconductor ETF, you might wonder why I did not talk about Soss ETF, iShares Semiconductor ETF. It's mainly because I prefer SMH ETF to Soss ETF. Okay, there are a few reasons for that. Firstly, I like TSMC. TSMC accounts for nearly 13% of SMH ETF weightage, but only accounts for 4% in the Soss ETF weightage. Secondly, I like Nvidia. Nvidia accounts for 20% of SMH ETF weightage, but only accounts for 9% of Soss ETF. Thirdly, SMH ETF is larger in AUM size and has better liquidity. For example, in terms of AUM, SMH ETF is 18 billion. Soss is only 12 billion. Okay, fourthly, SMH has better long-term performance. In terms of 10-year annualized return, SMH ETF is 26.6%, while Soss ETF is just 25%. And if you have been monitoring the ETF market, you will also notice that SMH ETF is one of the top performing ETFs this year, with a year-to-date return of 34%. One of the reasons for this outperformance is Nvidia, which has returned 91% so far this year. Nvidia itself contributes to about half of the 34% increase in this ETF this year. Having said that, if you really like Nvidia, this might be a good ETF choice for you. So while it might be tough to convince yourself to gain exposure directly into Nvidia, you can still gain Nvidia exposure through this ETF. The ETF itself is heavily concentrated on the top 10 holdings, which accounts for 73% of the total weightage. Nvidia alone accounts for 20% of the portfolio. So other than Nvidia, the top 10 holdings also include TSMC, Broadcom, Qualcomm, Texas Instruments, Micron, ASML, Applied Materials, Lam Research. All of these are good semiconductor companies. This ETF invests in the entire value chain of semiconductors, which will benefit from the AI revolution since AI development relies heavily on semiconductors. However, this ETF lacks exposure to software application companies like Google, Microsoft, Meta, and Amazon. So as a result, investing in this ETF alone will not cover the entire AI-related themes. So from the sector breakdown, we could see that 100% of the investment are in technology sector, specifically semiconductor stocks, with a heavy focus on US companies making up about 78% of the total portfolio. The year-to-date return is about 34%. The 5-year annualized return is 34%. In comparison, the Nasdaq 100 has a 5-year annualized return of 19%. And the 10-year annualized return for this ETF is 27.99%. In comparison, the Nasdaq 100 is 18%. So it's also one of the best performing ETFs in the world. However, traditional financial wisdom also tells us that high risk, high return. So we could see that the 5-year maximum drawdown was 47.6%. The volatility itself is 35.5%. So here I'd like to show you all these 3 ETF in one slide. There are 3 key takeaways. Firstly, if you prefer a more diversified AI ETF, Aiq ETF is likely the preferred choice. It has a diverse range of stock holdings with various sectors and countries. Aiq includes all the Magnificent 7 stocks, while Igpt only features 3 of them, and SMH ETF includes only Nvidia. Secondly, Igpt ETF has a longer track record than Aiq ETF. The 10-year annualized return is quite good at 15%. Year-to-date return is also quite decent at 17%. In terms of volatility, Igpt ETF lags behind. The AUM is quite small at $298 million. So naturally, you would expect Igpt ETF to have the lowest trading volumes, widest bid-ask spread, and highest tracking error among all the ETFs introduced today. Thirdly, if the performance is the main consideration of choosing an ETF, then SMH ETF, which is the top performing ETF here, will probably be a good choice. The year-to-date performance is 34%. It's my favorite ETF among the ETF I introduced today, but it's worth noting that the SMH will not cover all the AI-related stocks. because SMH ETF is a semiconductor ETF after all. So you might still need to find some AI software applications stocks to be included in your portfolio to complement the SMH ETF. You still need to go to do the hard work by including other Magnificent Seven stocks to ensure a comprehensive coverage itself. Okay, that's all for tonight. If you have any questions, please type it in the chat box and then I will try to answer them one by one. Okay, I don't see any questions. Okay, thank you everyone. Happy trading, happy investing. Hope to see you again. See you next week. Bye.